What if the greatest financial mistake of your life isn't losing money? What if the real danger is spending decades chasing returns, while ignoring the assets quietly compounding wealth in the background? Most investors become trapped in a cycle of urgency. They chase momentum, headlines, volatility, excitement. But financial history tells a very different story. Across inflation crises, oil shocks, recessions, the dot-com collapse, the global financial crisis, the pandemic, and the modern interest rate war, a small group of companies continued doing the same thing, paying shareholders again and again, year after year. Not speculative businesses, not hype-driven stories. Dividend aristocrats, companies so financially resilient, they continued increasing dividends while entire sectors collapsed around them. And here's the uncomfortable reality. If you had consistently invested in a handful of elite dividend aristocrats 20 years ago, your dividend income today could potentially replace a meaningful portion of your salary without selling a single share. That is the real power of compounding, not excitement, not prediction, ownership. In this video, we'll break down 10 dividend aristocrats I would personally consider worthy of a true buy and hold forever strategy, analyzing dividend growth, free cash flow durability, competitive moat strength, and long-term yield on cost potential. Because in wealth creation, survival is not enough. The objective is to own businesses engineered to compound for decades. To qualify as a dividend aristocrat, a company must increase its dividend for at least 25 consecutive years. That single requirement eliminates most businesses immediately. Because surviving one economic cycle is easy, surviving multiple decades of inflation, recessions, credit crises, market crashes, and interest rate shocks, while continuing to raise shareholder payouts, that is exceptionally rare, and it requires one thing above all else: resilient free cash flow, not accounting profits, not temporary growth narratives, real cash generation, consistent, durable, predictable. This is why dividend aristocrats tend to share the same structural characteristics. First, dominant market positioning. Second, pricing power during inflationary environments. And third, business models capable of surviving recessions without permanent damage. Over time, many of these companies evolve into something even rarer: dividend kings. Businesses that have increased dividends for more than 50 consecutive years. Think about what that actually means. Those companies survived oil crises, multiple bear markets, currency shocks, technological disruption, and entire economic regimes changing around them. Yet the dividend kept rising. And for long-term investors, dividend growth matters far more than headline yield. A company yielding 2% today, while compounding its dividend at 10% annually, can eventually generate far more income than a stagnant 7% yield attached to a deteriorating business. That is where most investors misunderstand dividend investing. They focus on immediate income. Sophisticated investors focus on future income dominance. And that distinction changes everything. First, Johnson & Johnson, ticker J&J. Dividend yield, approximately 3.1%. 5-year dividend growth rate near 6%. Payout ratio, roughly 45%. Johnson & Johnson represents the purest form of defensive compounding. Healthcare demand does not disappear during recessions. Patients still require medication. Hospitals still require equipment. Medical systems continue operating regardless of economic conditions. That creates extraordinary resilience. But the real strength lies in diversification. Pharmaceuticals, medical technology, consumer healthcare exposure, multiple cash flow engines operating simultaneously. And perhaps most importantly, one of the strongest balance sheets in corporate America, that financial strength matters enormously during periods of economic stress. Because elite dividend investing is not just about maximizing income. It is about minimizing the probability of permanent capital destruction. Now compare that to Procter & Gamble. Ticker, PG, dividend yield, approximately 2.4%. 5-year dividend growth rate, around 6%. Payout ratio, near 60%. P&G controls one of the most dominant consumer staple ecosystems on the planet. Its products exist inside millions of households globally. And during inflationary environments, that dominance becomes extremely valuable. Consumers may postpone luxury spending. They may reduce discretionary purchases, but they still buy toothpaste, laundry detergent, soap, paper products. That pricing power creates durable cash flow stability, which ultimately supports long-term dividend growth. These companies are not designed to generate explosive short-term returns. They are designed for something far more powerful: capital preservation, cash flow durability, and multi-decade compounding. True wealth-building businesses rarely look exciting. That's exactly why they work. This script provides a financial analysis comparing Johnson & Johnson and Procter & Gamble as examples of defensive dividend-paying stocks. It highlights J&J's resilience due to healthcare demand and diversification, and P&G's dominance in consumer staples, emphasizing their cash flow stability and capital preservation qualities. The core message is that these companies offer long-term wealth building through compounding rather than explosive short-term returns. Next, the Coca-Cola Company and PepsiCo. At first glance, these may appear to be simple consumer brands, but beneath the surface, they control one of the most underestimated forms of market power in global business: distribution dominance. Coca-Cola, ticker KO, dividend yield approximately 3%, 5-year dividend growth rate around 4%, payout ratio near 70%. PepsiCo, ticker PEP, dividend yield approximately 3.1%, 5-year dividend growth rate around 7%, payout ratio approximately 65%. These companies operate at a scale that is extraordinarily difficult to replicate. Their products move through massive global distribution systems, across supermarkets, restaurants, convenience stores, vending infrastructure, and international supply chains. That infrastructure itself becomes a competitive moat, and over decades, that moat compounds, because dominance is not built only through branding. It is built through logistics, shelf space control, supplier relationships, global distribution efficiency. That is what protects cash flow durability. Critics often dismiss these companies as slow growth, but that misses the entire point. When moderate growth is combined with uninterrupted dividend reinvestment, the compounding effect becomes extremely powerful over long-time horizons, especially during volatile market cycles, when speculative companies struggle to survive. Compounding does not require excitement. It requires endurance, and few business models endure like global consumer staples. Now let's shift toward higher yield opportunities. First, ABBVIE, ticker ABBVIE, dividend yield approximately 3.8%, 5-year dividend growth rate nearly 8%, payout ratio around 53%. ABBVIE offers a very different dividend profile from traditional consumer staple aristocrats. The income potential is materially higher. And historically, the primary concern surrounding the company was patent concentration risk. More specifically, Humira. For years, investors questioned whether ABBVIE could sustain long-term cash flow growth once exclusivity pressures intensified. But management responded aggressively. The company expanded its pharmaceutical pipeline, diversified revenue streams, and strengthened next-generation immunology and oncology exposure. That diversification matters enormously for dividend durability, because sustainable income investing is ultimately about one thing: the ability to keep generating cash flow through changing business cycles. Now compare that with realty income. Ticker O, dividend yield approximately 5.5%, 5-year dividend growth rate near 4%, payout structure typical REALTY model. Realty income is one of the most psychologically effective dividend investments ever created. Why? Because it pays monthly dividends. And over long periods of time, that consistency changes how investors experience passive income. The company even brands itself as the monthly dividend company. But beneath the branding, the real strength is structural. Its portfolio focuses heavily on recession-resistant tenants, operating under long-duration lease agreements. That creates highly predictable rental cash flow, and predictability is extremely valuable in dividend investing, especially during periods of economic uncertainty. This is not hypergrowth. This is systematic cash flow engineering. Built for durability, built for income, built for decades. Three more elite compounders deserve serious attention. First, McDonald's. Ticker, MCD. Dividend yield, approximately 2.2%. 5-year dividend growth rate around 8%. Payout ratio near 55%. Most people still view McDonald's as a restaurant company, but financially, that is only part of the story. McDonald's operates one of the most powerful franchise and real estate systems in the world. The business collects highly predictable cash flow from franchise locations, while maintaining extraordinary global brand dominance. That combination creates resilience, especially during uncertain economic periods, when consumers often migrate toward lower-cost food options. The result is a business model designed for durable long-term cash generation. Now look at Lowe's. Ticker, LOW. Dividend yield, approximately 1.9%. 5-year dividend growth rate above 15%. Payout ratio near 30%. This is where sophisticated dividend investors begin focusing on a critical concept: future yield on cost. At first glance, a sub-2% yield may not appear exciting, but when dividend growth compounds aggressively over decades, the long-term income profile can become extraordinary. Especially when paired with disciplined reinvestment, that is the hidden mathematics of dividend compounding. Small income streams, growing consistently for 20 or 30 years. Over time, the effect becomes financially transformative. Finally, automatic data processing. Ticker, ADP. Dividend yield, approximately 2%. 5-year dividend growth rate around 12%. Payout ratio near 58%. ADP operates inside one of the most deeply embedded layers of the corporate economy, payroll infrastructure. And once businesses integrate payroll systems into daily operations, switching providers becomes extremely disruptive. Those high switching costs create durable recurring revenue, which ultimately supports remarkably stable cash flow generation. And stable recurring cash flow is exactly what elite dividend investing requires: consistency, predictability, and endurance through economic cycles. Last on the list, Chevron Corporation. Ticker, CVX. Dividend yield, approximately 4.3%. 5-year dividend growth rate, around 6%. Payout ratio, near 50%. Energy is inherently cyclical. Commodity prices fluctuate. Global demand shifts. Geopolitical tensions create volatility across the sector. But Chevron separates itself through scale, balance sheet discipline, and integrated operations across the energy value chain. Upstream production, refining, distribution. That diversification creates stronger cash flow resilience during difficult energy cycles. More importantly, management has historically maintained a disciplined approach to capital allocation. And in commodity industries, capital discipline matters enormously, because dividend sustainability in energy is never guaranteed. Now zoom out from the individual companies, yes, and consider the larger projection. Imagine building a diversified portfolio of these dividend aristocrats, then reinvesting every dividend consistently for the next 20 years. Not trading, not chasing headlines, not reacting emotionally to volatility, simply compounding ownership. If that portfolio compounds dividend growth between 6 and 9% annually, your future yield on cost could eventually enter double-digit territory. And this is the hidden phase most investors never reach, because the early years feel slow, sometimes painfully slow. The progress appears almost invisible. But compounding behaves differently over long time horizons. At first, it moves quietly. Then eventually, it reaches escape velocity. And suddenly, the portfolio begins generating a meaningful passive income stream, independent of market sentiment, independent of daily volatility, independent of short-term noise. That transition changes investor psychology permanently, because at that point, the portfolio is no longer simply an investment account. It becomes a financial cash flow system. But there is an important warning here. Even elite dividend aristocrats can become dangerous investments if purchased at irrational valuations. A great business does not automatically create a great investment outcome. Price still matters. And periodically, certain dividend aristocrats become so overcrowded, so aggressively priced, that future returns remain compressed for years. This is why disciplined investors monitor valuation metrics constantly. price-to-earnings ratios, free cash flow coverage, debt levels, payout sustainability. Because dividend investing without valuation discipline eventually becomes performance destruction. There is also the classic dividend trap. A high yield alone means absolutely nothing if the underlying business cannot sustain cash generation. In many cases, an abnormally high dividend yield is not a sign of strength. It is a warning signal. The market may already be pricing in deterioration. This is why serious dividend growth investing follows a very different philosophy. Quality first, income second. Because ultimately, the objective is not maximizing yield today. It is maximizing reliable income decades from now. That distinction separates short-term income chasing from true long-term wealth compounding. So here's the question. If you could only hold 3 Dividend Aristocrats for the next 20 years, which would you choose? Write them in the comments below. And if you value disciplined long-term investing strategies centered around compounding, passive income generation, and elite dividend growth companies, subscribe to the channel. Because in volatile markets, consistency becomes a competitive advantage.